In 2022, the Russian ruble was surprisingly strong, propped up by capital controls and very high oil prices. But its strength was something of a mirage, because in 2023, the Russian ruble has fallen to below 100 to $1. A ruble is now worth little more than 1 cent, with a growing crisis in the Russian economy. But what happens next? Will the ruble's decline continue? And if it does, how will it affect the economy? Well, the ruble is falling for several reasons. Firstly, since last summer, oil and gas prices have fallen dramatically. And with energy accounting for 20% of Russian GDP and nearly 50% of its export revenue, these falls in energy prices have really reduced ruble earnings and the ability of the government to raise tax revenue too. And these falls in oil prices have been magnified by the G7 $60 cap on Russian oil. This is costing the Russian economy around $160 million a day. It's pushing down its selling prices. February 2023 saw a 40% fall in Russian export revenues. And despite countries like China and India continuing to buy Russian oil, it is selling at a large discount to the global price. Thirdly, Russian military spending is surging due to the ongoing war. Reuters report that Russia spent nearly 2 trillion rubles, $26 billion, on defence in January and February, a 282% rise on the previous year. And this surge in government spending is leading to a rise in import spending from countries like China, which means they have to sell rubles to buy foreign currency, putting down pressure on the ruble. But combined with the fall in export revenues, it's struggling to afford them. In 2023, Russia's current account surplus has fallen by 86%, as imports rise and exports revenue declines. Another factor is that since the invasion of Ukraine and the new conscription laws, many Russians, especially young men, have tried to leave the country, taking with them their savings. Countries like the United Arab Emirates and Thailand have seen an influx of Russian wealth, which means people selling Russian rubles to get foreign currency. Last year, Russia cut off gas supplies to its biggest consumer, Europe. But surprisingly perhaps, Europe was much more successful than expected in diversifying away from Russian gas. And the long-term effect, though, is that Russia has lost a very important buyer of its energy, which was a big factor in its past economy. And finally, as the Russian ruble falls, this creates inflationary pressure. A lower value of the ruble means imports are more expensive, pushing up inflation. But ironically, as inflation goes up, this in itself puts downward pressure on the ruble, because Russian goods look less competitive, therefore less demand for them. So it's this downward spiral of inflation and devaluation, which can continue. And this is a strong dynamic at the moment. Now, in response to the fall in the value of the ruble, the Russian central bank has only limited options. It has a limited ability to intervene in capital markets directly, because $300 billion of foreign reserves have been frozen by Western sanctions. So in response, the Russian central bank increased interest rates quite dramatically by 3.5 percentage points to 12%. But this only had a relatively minor impact on propping up the ruble, because unlike other currencies, there's very little, if any, speculation in the ruble. Even if interest rates increase to say 20%, there are very few foreign investors who would want to save in Russian banks. So the interest rate tool is less effective than it would be in other countries. The important thing is that the fall in the ruble is not about speculation. It's reflecting these fundamental textbook economic forces: less demand for exports, lower export revenue, and increased spending on imports, all reducing the value of the ruble. The only real solution available to the Russian authorities is to bring back more stringent capital controls, for example forcing exporters to convert 80% of foreign currency to rubles. But although capital controls may prop up the ruble to some extent, they do have a cost, because private investment is already quite weak because of corruption and loss of confidence in the economy. Capital controls is another thing that will make it less attractive, another factor hurting the private sector of the Russian economy. And capital control is really more of a sticking plaster than dealing with the underlying problem. Because outside military spending and government subsidies, the Russian economy is in dire straits, hit by Western sanctions, lack of business confidence, loss of entrepreneurs and young skilled workers. The economy is struggling to diversify away from reliance on fossil fuels and state subsidies. And the war has been very disruptive for the peacetime economy, with many of the best skilled workers being lost. And the loss of Western investment has hit high-tech sectors like IT, and has only been partially replaced by investment from, say, China, which has its own economic problems at the moment. Now, the OECD predict a 2.5% decline in Russian GDP in 2023. The IMF forecast a slight rise, although that is based on Russia's own economic statistics, which is unreliable to say the least. But if you exclude the temporary military spending, the underlying economy is much weaker, because the economy at the moment is to a large extent being propped up by very high government spending. But as the government deficit increasingly rises, there's a limit to what can be borrowed. Dmitry Polyev, head of investment at Loco Investment, says that the economy, in our view, is now like a bodybuilder on steroids. Once these steroids are exhausted, it will be far harder for the economy to show growth. For example, the recent increase in interest rates to try and prop up the ruble will increase borrowing costs for the government, increase the cost of servicing the debt, and also increase costs for private investment too. And what about the impact of a fall in the ruble? Well, it's definitely hitting the average Russian consumer, because they will notice it immediately in the form of higher prices in shops. Imports will become more expensive. And on top of this, now interest rates are much higher, so there'll be higher borrowing costs. So it's a difficult trade-off. You can raise interest rates to try to prop up the ruble, but this will worsen economic growth and private investment, which will increasingly hurt the economy over a longer period of time. The only real solution to the woes of the Russian economy is to end the war in Ukraine, reduce military spending, and negotiate the end of Western sanctions. The current trajectory of the Russian economy is to increasingly meet supply constraints, higher inflation, and a weaker currency. All these will reduce living standards, especially for the average Russian consumer. So the fall in the ruble is really very significant. It does reflect weakness in the Russian economy. And the fall in the ruble will make life more difficult to manage the Russian economy, reduce its spending power, reduce living standards, and also reduce confidence. If you found this video useful, please give it a thumbs up and do subscribe to the channel. There'll be lots more great videos coming along soon. Cheers, bye.